Good weekend all. Ira Epstein of Linn Associates with your agriculture update. And this is your weekend edition for Friday, the 5th of July, 2019. And the time right now, well, we're sitting here just about 1:30 p.m. Central Daylight Time. As you know, we have questions galore as to what's going on in the corn market in terms of acreage, because on the last USDA report, the acreage number that was planted was larger than last year. And none of us can figure out how that can be with all the flooding to prevent planting that went on. It doesn't seem right. So the government agrees, just doesn't look right, but they go by surveys. So they're doing another survey, but we won't get that until August. So the reports we're going to get in July, they're based on what kind of acreage? You got to extrapolate, and it's going to be rough. In the soybean market, we're still seeing problems as price wants to break back a little bit here as the beans that are in now, and basically whatever's in is in, well, they're getting better growing weather, so that's helping to a degree. Now, as we take a look at a monthly area chart of closes, you'll notice we haven't gotten up to the red line, which is the 18-month moving average of closes. And I'm telling you, you haven't done that since 2018. So this whole rally has really not been able to carry that far. Are prices as bad as you hear in the news? Well, if you just look at the closing prices, the answer is no. They're down from their peak in 2018, but they also haven't been making lower lows. So that's important. We see that when we go to the weekly bar chart. You're not down at the depths of this market in the 780 level. You're about $1 higher than that now, around the 872 zone, but you've backed away over the past 2 weeks from this high stab that you made. And if you'll recall, we were talking, you were into a zone of resistance from back here, and that just proved to be on this leg of the market too much. I use the word this leg because we're still very much in a weather market, and if there are surprises, they're probably to the upside as events start unfolding during the growing season. You've also got to remember, we planted late, so what happens at the end of the growing season when the plant turns off or it gets cold? There's two different things that happen there based on sun days or weather in terms of coolness. As we take a look at the swing line study, you're still in a bull trend. Higher lows, higher highs. That stays in place unless you take out 848 1/4. Where's support? Right here. So the market fell back on the weekly chart, where I think this is where the pros that are longer term oriented are going to support the market. I think they'd have their stops under 848 1/4. One of their points could be if they get some information that's more bullish. The crops now maybe back to the 100-day average, which they did not challenge on this first big leg to the upside, or the Bollinger Band. But because the 100-day average is in front of that, I'm inclined to think the 100-day average would be your first resistance point, because you can't get to the Bollinger Band without getting through that. I think that makes sense. In momentum, the momentum in the market has turned to the downside. Not dramatically, but it has waned. And you see that with prices over the past 2 weeks, so that fits in. And remember, on the weekly charts, we're not looking for overbought or oversold. We're simply looking as the thrust up, down, or sideways. Thrust, it's not pointing sharply lower, it's working its way down. That's why I think that 18-day average, a week average of closes is the support. In the meal market, you came down. If you take a look, the 18-week average is 306.30. You finished out at 303.80. This market went into a downtrend. You now have lower highs, lower lows. You settled under the 18-week average. Momentum is pointing down. So until the market clears back up through this area that we pinpointed with the 100-day average of resistance and the upper Bollinger Band, that combination being rather a formidable resistance, the market, as it turned out, wore itself out there, and now the market seems to be working its way back to the downside. I don't know if it puts into play 286.60, the lower Bollinger Band, but it is one of the numbers for it if it continues down. The pivot will be around that 18-day average of closes. Soybean oil is still in the swing lines, pointing to an up pattern with higher lows, higher highs. However, if you take a look at the settlement at 27.44, it's well under the 100. The 18-week average. I used the wrong term there. 18-week average, that's the 100 up here. And that means you've still got the downside bias. What else? We know this market has been pulled along with beans and meal as they've been moving, and it ran into its resistance right at that line in the sand, as I like to call it, that 18-week average of closes. I would call this market nothing. In other words, I've got the bias down, the swing line up, momentum sort of flat, hard market. In the corn market, you still are under the influence of a pattern of higher lows and higher highs. That is bullish. What the market did is, because of this run that it had, this dollar plus run, the market, when that occurred, stayed over the upper Bollinger Band. When that's occurring, I realize it's hard for you to accept the fact that 95% of the time the market's going to find a way to get back into that Bollinger Band, but it does. And that doesn't mean you get bearish, but it means you curb your bullishness. And now the market's back over here. It's still in that zone, but it's given up the top part of the band, and it wouldn't surprise me if the pros are now looking for another piece of information to say, gee, do I get bullish here? Let me explain if the market doesn't get bullish. If we get some news that is a bit that the crops look better, so on, the weather's better. Well, if you take out 407, that puts into play the 387 mark, the 18-week moving average of closes. What the bulls don't want to see done is taking that out, because if you take out 407, what happens is you lose the pattern of higher lows, higher highs. That doesn't mean you've lost your upside bias, because you'd have to close under 387 3/4 to do that. But momentum is flirting with trying to turn down here. It's not done it. It's just sort of flattened itself out. But take that out, and I'd be surprised if it doesn't turn itself down, and that could put this into play. So until it occurs, though, what do you think? I think the bulls try to support their position. In the wheat market, we went from here, this 416 level, all the way to 558, spent 3 weeks over the upper Bollinger Band, and bang. I wish I could tell you I'm surprised. I'm not. I'm thrilled that it did what I was telling people. That I said, you know, if you're buying that, first of all, it's a vertical price rise. Where do you even put a stop? Number two, you don't start fighting Bollinger Bands. You will find that you get hurt fighting those. So this was simply saying that you can probably do better on an entry point than buying over a Bollinger Band. Now, where I see the support coming in, and I'm not saying the market will go here, but the combination of the 18-week and the 100-week is very impressive to me. Sooner rather than later, you're going to get that 18-week to try to cross over the 100-week, a bullish crossover. And if you get that with prices staying over everything, you put back into play the potential of the upper Bollinger Band. The way this pattern is right now, I wouldn't know where you'd have a stop if you're long. You're going to go way back here? It's too hard because of that straight vertical price rise. In the cocoa market, at least on the weekly chart, you still have the pattern of higher lows, but you also have lower highs. You also have momentum turning down. And on the daily chart, I've been showing people how it's just whipping traders back and forth, and you're seeing that. This market has upside bias because it's over the 18-day average. It has downside momentum. It has the swing line legacy, still higher high, higher low. But you don't forget the fact that you've just got the new pattern of lower highs. I think neutrality. When we come into the sugar, you've hit an important number. I want you to look at the 100-week moving average of closes. I get confused sometimes, the weekly and the daily. But the averages are the averages. This is your resistance. You're back to it. Are you in an uptrend? You certainly are. You have the higher lows, the higher highs. You're at a resistance point. If it can poke through this, then I start looking for the upper Bollinger Band at 1306. Where do I think support would come in? Right here at the 1231 level. You finished at 1236. That green line, the 100-week average, is a bit formidable of resistance. To break this all down, well, that gets the interesting part. You'd have to take out 1198, but this week's high was 1282, which took out 1278. So even if you took out this 1198, you're not in a downtrend. You'd be out of the uptrend, but not in a downtrend. So the onus is on the bulls to support it and not let the market get under 1198. In the coffee market, if you knew nothing else, here you are coming over the upper Bollinger Band last week. If you're going to follow through, I'm going to look for resistance because it's here in the 100-day average. Otherwise, I'm looking for the market to back under the Bollinger Band. What the market do? It went up this week, hit that number, closed over the upper Bollinger Band, but I now say you're in a very, very strong resistance zone. This has peaked out the market before. So that doesn't mean that you can't take it out and keep going. It means you cut your positions back and you make sure the market has the momentum to keep going if one is bullish. In the cotton, you're still very much in the bear pattern. Doesn't look like it on the daily charts, but when you come to the weekly, you've got clear-cut lower highs, lower lows. You've still got downside momentum, downside bias. To negate the downtrend, you'd have to get back over right through here, the 70.83 level. And my guess is this week's moving average is going to drop very close to that or under it tomorrow. See, I'm going back and you can see it's moving 30 to 40 points at a shot. So assuming that happens next, when we reopen on Sunday night, I'm thinking it'll be under that number. So wherever that number comes in is where I think the pros could get a bit aggressive on the bear side. In the cattle market, this is an ugly chart because of this. You had an outside week up last week. My rule is, be it on a daily chart or a weekly, you cannot take out the low of an outside week up. If you do, you create what's called a bull trap. And the reason it's a bull trap, you got people here trying to get the market to keep going, and when you take that out, they're all caught. So everybody above this that is long is caught. Is the market going to the lower Bollinger Band is the question. Resistance keeps dropping down. Be careful coming up soon because you're no more than 2 weeks away from the looks of it, where the 18-week average is going to get under the 100. That's a long-term bearish look to the chart. In the hog market, another case of swine fever was found in China. Vietnam's got plenty of it, yet we're not selling that much of our pork. We still have lower highs, lower lows. You can see how the market momentum is down, the bias is down. You have two levels of support coming at you now. You've got the 64.15 of the Bollinger Band and the 66.90 of the 100-week average of closes. So you put it together, you have an interesting game. And what went on today is interesting too, because the government came out and said we got a lot more jobs than anyone thought. We thought we'd get 160,000, got 224. That's good. So now what does it do for these markets? Well, you start guessing. And the guessing comes in, is the Fed going to make a move or not make a move? What's going to happen with the weather for the grain markets? You start worrying about all that. And I bring you up to date because each morning at 6 in the morning, I'm hoping you get a cup of coffee. You don't have to at 6. You can do it about 40 minutes later after I finish the recording, rendering, and post it. But I'm going to be able to bring you up to date with what's going on in Asia, what's going on in Europe, what the American markets are looking for. I review 40 futures charts and about 5 ETFs. So the idea here is we're going to do some technical analysis, we're going to talk some fundamentals early in the morning, and then the trade recommendations. Points of entry, exit, profit objective, stops, that all comes into play. And the beauty of the way that I do it is it's all done on this video, and all you're doing is on the bottom of it, you can pull. There'll be the little bar you can pull. There'll be a lexicon on the right-hand side of it as well. And any area you want to go to, just hit it. It'll take you there. So let's assume you're in the grains. You don't want to know about the stock indices. Don't look at them. Just go right to the grain part. Away you go. It's very inexpensive. A joke, intentionally. And I keep it that way because it's about building a following to me. And what it comes down to is I charge 26.5 cents a day for the first 30 days. After that, it's $15 for the next 30 days, or you can go to a one-year subscription for $156. And of course, at any point you can quit. That's up to you. But I think you'll find that at this type of value, to wake up, get somebody talking to you about the chart action, what's going on that early, you're caught up. And if there's some big event that happens, I put out an extra video. How do you find out more about it? Because we explain it in detail. Go to our website, www.iraepstein.com. Under Education or Research, just take a look at Ira's Morning Subscriber video. It explains everything right there for you to see. I'm Ira Epstein. Have a great weekend. I'll see you all Monday.